when you look at what's happening in China domestically with the economy and with the political structure, I'm also curious about their outward political projection. And I do worry about Northeast Asia, not just China, but Japan, Korea, Taiwan. And I'm curious, since you have such a historical background, I'm curious what you think about China in terms of political projection, say for 2022. Are you worried that they're going to become aggressive in 22?
Not 22. I
Okay.
think they've got. I think the domestic. You've got enough crap on your own doorstep at home without exacerbating the situation. And if you actually look through what's going on, well, you can read what the Global Times says and things like the Uyghur bill. It's clearly going to cause some short-term aggravation. But overall, my sense is over the past few months, we've had more of a nuanced approach that we need to just tone it down a bit, just dampen down the wolf warriors a little bit.
They're getting,
you know what I mean?
Yep.
Down the line, ultimately, I mean, clearly Japan is arming significantly. Australia, we got the whole Quad or whatever you want to call it.
Right.
And so, I mean, one of the biggest problems, of course, has been the abject failure of US foreign policy over the past 20 years. So, apart from Gulf War II, the worst disastrous war in history ever, when we look at its consequences, then the GFC. So they're all focused on various different things. So, China's loved a vacuum and it's been able to get away with loads of stuff. Obama's foreign policy towards China was, not just China, obviously, but other countries as well, abject. And much as it irritates so over here I'm talking to people, people love ranting about Trump, and while presentationally he was awful, the foreign policy actually was the best foreign policy seen from the US in decades. Well, okay, assisted by, you could call it the establishment as well, but
I think that the difference there is it was outcomes-based foreign policy, right? And I think what Americans have forgotten, particularly over the last 30 years, is it's really been inputs-based foreign policy, values and other stuff, which is great. But, we had, I think, through the probably 50s, a very pragmatic outputs-based foreign policy. What are the outcomes? That's the objective. And diplomacy schools, my graduate work was in diplomacy. They've really focused on the other side of the equation with a fuzzy idea of the outcomes. And I think what Trump brought, like him or hate him, what he brought was a dogged focus on the outcomes of foreign policy, right? And so a lot of people hate him, that's fine, but it was a very pragmatic foreign policy environment in the US.
Yeah, I mean, going forward, and I think there's a legacy of that now. I mean, the one thing that Congress, the only bipartisan issue on the Hill is China.
Mm-hmm. Yep.
And Trump didn't give a damn about human rights in the Uyghurs or Hong Kong. He made it, he had veto-proof majorities that he wasn't going to go through the humiliation of having a veto overturned. So he just had to roll with it. It actually was more of an inconvenience for him, I think, and then people like Pompeo and the military as well. But right. But overall, I think China, going back to the South China Morning Post article, they were saying that China could hit 5% growth with all the stimulus. Now, if you look at what real GDP activities now, the fixed asset investment, this year, forget about the year-on-year number because that's it's still distorted, but it's only grown. So I go through the data. I do a lot of data mining. I'm not particularly quantitative. I just sit there with my simple Excel 1 plus times that.
Sure.
There's only growth. Fixed asset investment is only up in nominal terms 1.6% year to date.
Right. That's a developed market, a developed economy number. That's not a growth economy number.
And that's a nominal number, don't forget. Right. So given that fixed asset investment uses lots of steel and cement and commodities, which have all gone up in price, actually that number's a big fat real negative. And that's sort of 49 year to date. I think the MBS came out year to date. That's 49 trillion CNY. So pretty much still up there. That good sort of 45% of GDP. Retail sales are only up 3.9%, but allowed CPI 1.6. Well, either number is still like the lowest on record outside of the immediate pandemic shutdown. So you sort of wonder where on earth they come up with their growth numbers for the year,
right?
Given that, okay, and they've got a bit of boost to net exports from the trade surplus,
right?
And a collapse in tourism because Chinese are the big tourists. So the current account is being boosted, so that flatters the GDP. But even the Chinese next year expect net exports to come down. And if I'm right about the durable goods argument, then that's even worse for the Chinese trade surplus.
Sure, I think you're right.
So you're left with, what can they do?
Can I ask you also something, because you mentioned retail sales and consumer goods, and I'm curious, with all of the real estate woes in China, how much of consumer debt in China is secured by real estate assets? I mean, is that an issue, and how much of a crimp will that put on consumer spending?
That's a tough one because we know overall the LTVs are very low. But we also know that there's 50 to 60 million vacant apartments. Chinese have a surreal concept about owning and they count as an investment property. And if you rent it out, it sort of loses its virginal status, for want of a description. But the problem is, if you're introducing these property taxes and you're going into like that, well, then you are seeing second-hand homes. I mean, the official home numbers are nonsense when we know full well that developers are sending stuff at big, deep discounts.
Right.
But by and large, I think Chinese it will affect sentiment, and some people are highly leveraged, so there are, and personal bankruptcy is still an infant industry in China. It's not really established in the courts.
Oh, there's so much shit around it. It's terrible.
So it clearly is already dampening consumer confidence, and if the real estate slowing and production. So we know that new land sales have collapsed. So that tells you going forward over the next 2 years, new construction activity is going to be much reduced. And if you're not building homes, then you're not going to be filling them with washing machines and I mean, I was actually looking at I think it was the big lift manufacturers like Otis and stuff like that, and you're just going like, you look at the stock price and I think they're up there, and you're going like, well, Chinese real estate's going down there. Right. You're just thinking like, yeah. I mean, I basically have a big aversion to anything construction related or household good related, full stop. But I mean, I'm not an equity man. I'm a bond man through and through. Yep. That's what I do. The curve.
That all makes sense. The logic is there, and given the direction we're headed, all of this makes a huge amount of sense, especially for kind of 22. I think 21, a lot of it's behind us, and there were a lot of questions and a lot of, I think, still skepticism around what we've heard globally in 21 about the impact of spending and monetary policy. But Patrick, let's just, if you don't mind, you had mentioned U.S. foreign policy. So let's focus on the U.S. for a minute. And with the midterm elections in the U.S., and you seem to be skeptical about kind of positive momentum in the U.S. economy. I'm really curious what your view on the U.S. is for the year ahead.
Well, we've got two things. One, we've got a big fiscal contraction. We shouldn't, we shouldn't underestimate how much the fiscal expansion has flattered the US economy because it was so large. And that's clearly massively in reverse. I mean, one of the things I don't know the exact details of it, but something that US equity analysts conveniently seem to ignore when it comes to earnings is when I asked if I asked the question, well, don't you think sort of 800 billion of PPP loans might have flattered your figures as a whole? All the other loans to airlines or stuff like that. I mean, US airlines basically got extremely generously treated. UK airlines haven't. You look at like BA or Virgin Atlantic.
A lot of Americans are really unhappy about all the money that airlines got because the quality of service is terrible.
Yeah, but for example, so we don't, the distortions. It's really like they're still echoing through. A bit like I was talking about the monetary stimulus. So it takes longer to pass through the economy, or what's the analogy? It's like a python eating an elephant.
Right.
It just takes longer to digest.
Right.
Okay, python eating, probably a bit of an extreme example, but you know what I mean. You get the point.
Yeah, no,
the imagery.
It works.
And so when we look at it on the fiscal front, we know that's much less. The hopes for fiscal stimulus, if you think where we were at the beginning of this year, and everyone was going, oh, wow, it's great, Biden's going to push so much through. Well, we only just got the infrastructure bill through. And
underwhelming infrastructure bill.
Yeah, and Build Back Better is still not through. And in fact, the centrist Democrats are resisting, not just Manchin, but overall, there's much more of a realization that, just look at Biden's approval rate. So the good thing is it's supposedly damping down the progressives. I could use a different word for them, but and then clearly Virginia shocked the Dems, and it's basically long-standing Congress people are retiring in record numbers because they don't want to have the humiliation of losing their district come the midterms. So let's presume that the form book is correct, that basically Republicans probably take both houses, certainly the House. Well, that stymies everything. It means the administration's got a window of doing stuff, plus it's dealing with inflation and stuff like that. And it's almost like, so now you've got the administration going, well, we want fiscal stimulus, but actually, holy shit, the inflation's got out of control. We need the Fed to come in. And lo and behold, the Fed has just had we've had a big move in the short-term rates pricing to the point when you've got 60 basis point increase in the dots, which we've never had before. And if you'd said to someone a year ago, oh, what do you think would happen if 60 basis points was added to the dots in a quarter? They say, oh, the dollar would surge, the curve would flatten. In fact, what we're seeing is because so much is priced in, that the curve is steepening and the dollar is softening. But there are other elements going on there as well. And if the US economy in the the greatest economy ever couldn't handle rates going back to 2.5% and a minor reduction in the size of the balance sheet. And my view was that the Fed should have probably stopped at 1.75% rather than 2.5% at most, because they forgot about the lags that they keep on telling us about. That the idea that the US economy with so much more debt, normally it's gone from 250% of GDP to 275 now.
Right.
Okay, inflation will bring that down a little bit, but it's gone up by 10% as a percentage of GDP. So it's how sensitive is the US economy going to be to 150 basis points? Certainly, this is what the Fed is talking about now by the end of 2023, another 50 in 24, plus balance sheet reduction as well. I just can't see it getting there. So I'm skeptic that we'll necessarily see Fed funds getting back to 1%.
2 years is a long time.
2 years is a long time.
So
Yeah.
I think in general terms, what I'm seeing, and I'm not sure if this is what you're saying, but for the past 2 years, we've seen a private sector that's been fixated on the public sector, meaning the COVID regulations, the COVID stimulus, all this stuff. And it seems to me that with that stimulus disappearing and with the chaos in DC and at the state level, private sector will start focusing on the private sector and their customers instead of government. Does that sound fair? As a fair assessment?
Yeah, although let's not be too nice on the private sector. I mean, there's large parts of the private sector that are clearly gouged over
Of course.
the interesting one is, of course, global shipping. So if global shipping's really disrupted and the costs have really gone up so much, how come is it that the people like Musk have made more money in the past year than they've made in the past 15 years combined? Because there's clearly oligopolies going on there, and they are gouging people. Well, that will fade over time. So my biggest concern is actually is the risk of a demand shock. So the Fed starts draining liquidity, and we forget just how sensitive the US and the global economy is to the flows of US money, and I think it's the flows that is the thing. So it's this whole point about there's a sort of delicate tipping point in terms of, if you think about it, I'm a big one for analogies. It's a bit like an artery. How low does the blood flow have to get before you faint?
Absolutely. So you're saying that the flow will stop, but the stock will remain. Are they going to start selling off those balance sheet assets?
The Fed at some point. Oh, sorry, the
But
Fed.
not in 22.
No. But I think they'll see. But it's clearly the fact that they've already talking about this in terms of let's reduce assets. That, well, fine, if we do the 75 basis points, we're not going to wait till we get to 1.5, or as it did last time around. We'll probably start reducing the balance sheet, the balance sheet earlier, because it's a nice little tool, and actually it's quite a good tool if you want to crimp down on mortgages. So what was noticeable in the last redux was, because the Fed was buying such a large share of them all, pretty much 100% of all mortgage stuff, whereas it's not buying 100% of all treasury issuance. But once they started reducing the mortgages, that was when mortgage spreads versus like the 30-year mortgage versus the long bond actually really starting to widen out.
Right.
And then that mortgages are really the underlying credit of the credit market.
Of course.
So everyone says, well, treasuries actually, and I think mortgages are a better reference, than OAS or something. I'd rather look at a mortgage than bond against credit. And that it filters through to the whole credit market. And then we're left with a situation where you have record shares of US US business debt. If you look at the flow of funds reports, US business debt is a record share of GDP. So I love the bullshit we get from the corporates. So again, the equity analysts who, basically I think should not be left in a room with any hard surfaces. So they go out and they say, oh yeah, we got record amounts of cash on the balance sheet. So you had, I think it was Viacom. It was an article a while back, the Wall Street Journal, normal sort of, aren't the corporate sector wonderful? Viacom CFO going, oh yeah, we've got like 10.7 billion of like liquid assets on the balance sheet. At the same time, conveniently forget to mention that they had 170 billion of debt.
Right.
You've got 170 billion of debt, things go wrong. Your 10 billion doesn't go that far.
So, I've heard over the past few months, as talk of tapering has intensified, and I bring up the taper tantrum to people from 2015, and there seems to be a resistance that we'll have a taper tantrum this time. And I kind of find that a little bit kind of rose tinted. Do you, like, there has to be a backlash?
Well, and I think we've already had it. I mean, quite honestly, I think we've already had it. If we look at some of the moves, if you're a rate trader and you specialize in rates, we had some big swings. You know, look at the curve. So 530s in the bond curve. Before the turning point, the tipping point was the minutes from the April meeting. So Powell had been going on about, oh, we're not even talking about taper. And then actually the minutes come out and said, some participants said it's time to maybe start discussing taper. And then the 530s was at 155. Well, we've been down to 55 now, 100 basis points with a big long end. So there's been a sort of subtle taper. I also think you have to go back to the psychology of, well, it was 2013 really, when we had the taper tantrum when rates exploded. We were still very much in a mindset, and central bankers were too, that we revert to normal, that rates would revert to where their previous level was. And it's the education experience, you know, and if you think about all those Fed projections, all their dot points, and it took them till the end of 2015 to do the first 25 basis point hike. It took them another year to do the second 25 basis point hike. So, you know, I think we're scarred by experience now. So there's not the taper tantrum as of such. At the same time, equities go like, oh, it's all fine, but they don't realise how sensitive the economy is to the marginal changes in money.
Very good. Patrick, thanks so much for your time. This was really a level of depth that I think everyone will appreciate. And I think the views are fascinating because it's a view of 22 that I don't think they'll get anywhere else. So thank you very much for your time, and just wish you all the best for 22.
Yeah, and to you. Happy Christmas, happy holidays, as you have to politically correct, so, and a happy New Year.
Thank you, sir.